Hello, in this lecture we're going to talk about startup businesses and types of entities. When a new business starts up, the first question often is, what type of entity should we be? Should we be a sole proprietor, an S-corporation, or possibly a limited liability company? We're going to talk about the pros and cons between those three. We will be able to, at the end of this, list types of business entities available for a small business. We're going to have an emphasis on the sole proprietor here, and I'm going to tell you why I'm going to basically emphasize the sole proprietor when we compare them to the other types of entities. And we're going to have tips on seeking advice about the business entity, and we're going to have the pros and cons of different business entities. So I do want to point out that you do want to seek advice from a professional. When you do seek advice from the professional, however, you do want to keep in mind what type of incentives the professional has. For example, if you go to a real estate broker and talk about the purchase of a house, you know that the real estate broker has a vested interest in selling the house because they get commission on the house. Well, if you're talking to somebody that is a professional at setting up a certain type of entity, then they probably have an incentive to sell that type of entity because they're going to make more money to set that up. Doesn't mean that they will give bad advice, but it does mean that there is that incentive, and you want to keep that in mind when you go there. So what's the advice? How could you guard against this problem? That you may want to go to someone and just pay them a set fee. Say, hey, I don't want you to set the thing up. I just want advice. I want to pay you hourly for advice on how I should set up my business and some advice about the business. And that way you're kind of taking away the incentive. You're just paying a set rate rather than paying for a set service. So we're going to start off with the sole proprietor here and go through the options of it. Again, this is the thing that most people start off with, is to become a sole proprietor and then change possibly as they go, as they grow. Why? Because one, it's really easy to set up. From the IRS's standpoint, if you just start doing business and making money, then you're a sole proprietor. You're supposed to report your income, and of course Uncle Sam wants their share of it. And it's less costly, of course, too, because again, all you really have to do for the sole proprietor is start making money in terms of what the IRS thinks as a business. If you just start doing business, you're a sole proprietor, you need to file the Schedule C and report the income on it. And that's basically it for the IRS side of things. Now, you may want to, as a sole proprietor, it's not required, but you could file for an application for employer identification number. Couple reasons to do this. One, if you have employees, obviously you would want to do this. But even if you do not have employees as a sole proprietor, you may still want to file for an employer identification number. Why? Because if you do business for somebody, if you do work, if you do a job, if you're a contractor and you do work, they may be required to 1099 you, meaning they might have to file a form 1099 and give it to the IRS, similar to a W-2, but just recognizing the revenue that's been given to you that you would then have to report on your taxes. And in order to give that form, they need a number. And if you don't have an employer identification number, then you'd have to give them your social security number. Doesn't look as professional, and you don't really want to be giving out your social security number. Therefore, you may want to get the SS4 form. It is on the irs.gov website, really easy to set up. And you could just do it electronically too on the IRS website. Other thing that comes up a lot of times for small businesses are that what should we call ourselves? Should we have a different name? Now, if you have a different name, if you want to have some other name, if you use your own name, if it's just like Joe Smith's company or Joe Smith's business, then you don't need to do anything different. Obviously, you can use that name, not a problem. If you're using some other type of name and you want to name it something else for marketing purposes, then you basically want to see if that name is taken. You can go to your Secretary of State's website and see if that name has been taken, and then you might want to set up doing business as. And you can look into that process and how you can set up the name for a doing business as type of name. You'd have to basically publish the name and whatnot in order to kind of claim the name. Then the sole proprietor also has less tax work. So basically the tax work on the sole proprietor, if you just started doing business and you just made money throughout the year, well, when you do your taxes at the end of the year, you'd have to include at least a Schedule C. And it's just one form that's just going to be attached to your 1040 here. And all it's going to have is going to have your income, it's going to have your expenses, that'll give you the net income, and that will be over here on the 1040. So note that we don't have any other form, it's not a separate entity. That form is just going to be attached to the 1040. That backs up the information. That's why it's kind of less costly in that way to be a sole proprietor, because it's not a whole nother tax return that you're going to be filing each year, it's just that one form. Now, the disadvantages of the sole proprietor is there's going to be unlimited liability. The sole proprietor is not separate from, the business is not separate from the personal. Therefore, if something happened, if you got sued or something like that, They can go after your assets, total assets, not just your business assets. That's the major problem with the sole proprietor. That's one of the major reasons people consider another type, an S corporation or a C corporation. You could limit that liability by getting liability insurance, which of course you would want, just about any business would want some type of liability insurance. More difficult to find outside capital. If you're a startup business and you need money to start up for the startup costs and you can't get a loan from it, it's easier from other types of business. If you're an S corporation or a corporation or a partnership, it's possible to give an equity interest in the business and raise capital in that way. The problem with giving an equity interest, of course, is that you have more people involved in decision making, or more people that have more influence over decision making. And so that's why I would recommend, if you cannot have that, if you cannot have a capital interest when you're starting out and you can have full control over the business, that could be very helpful to the business to do what you want to do within it. Now then there's a partnership. A partnership's kind of like a sole proprietor, but now you have two partners that are together. So all the sole proprietor characteristics are basically the same, but now you have the two partners. If you're just two people starting doing a business, then you're basically a partnership. Problem with partnership is you have divided authority. So that means that you don't really know who has the final say. You got the two partners. So that could be a problem. If you have a question as to whether you should be a sole proprietor with employees or a partnership, you may want to go with the sole proprietor with employees, because it makes it a bit easier for one person to kind of make the final calls and the final decisions. If you're going into it with a partnership, make sure you have a clear partnership agreement. Not everything needs to be split down the middle, meaning not all time needs to be split down the middle, not all income needs to be split down the middle, but it needs to be fair to both sides, and both people need to understand that it's fair on it. The sole proprietor, you would also have to file another return for it, because it has to basically report the income to the sole proprietor, to the partnership, then issue the K-1s, and then the K-1s would flow through to the 1040. So we have to have a whole nother return to file so that it can issue the K-1s. The actual income is not going to be taxed here. It's going to flow through and be taxed here, but it does require more work in that way, which is another reason you may want to set up as a sole proprietor if you have that option and hire employees. Then we have the S corporation. Many of the idea of the S corporation, the limited liability, are going to be similar, so I'm going to go through those here. If you were to go into an S corporation or an LLC, obviously there's more detail between those two that we can get into at a later time. But the major benefit of an S corporation or an LLC is reduced liability, meaning the corporation is separate from the entity. Therefore, if you got sued or something like that, then they should be able to go after the corporation, not the personal assets. That's one of the huge benefits of a corporation. Capital investments, you could sell stocks, so other people can have a capital investment. You can raise money that way to start up the business, but of course that means that other people have an interest in the decision-making process. Transfer of ownership, so if you were to leave the business or if someone died within the company lives after any individual owner because it is a separate legal entity, so that the entity can survive after like the death of an owner or an owner leaving, unlike a sole proprietor or partnership. More expensive to form. So this is where the cost comes in, of course, with setting these up. The S corporation and the LLC is similar in that you're going to need an articles of incorporation. You'd have to go to the Secretary of State website, whatever state you're in, and this is from the California website, and they will give you the directions on how to fill out the articles of incorporation, or what are the minimum requirements of it. We're also going to have the statement of information. Depending on what state, you may have the statement of information basically saying who the officers are and whatnot. You might have to file this periodically, like yearly or every 2 years, depending on the state as well. And then we have the election to be a small business. This is the IRS. So the IRS is basically going to see you as a C corporation until you file this form, a 2553. And this form basically says, hey, I want it to be a flow-through entity, an S corporation rather than a C corporation. You'd have to file that with the IRS. So this is not the state, this is the Fed, this is the IRS that you'd want to file that with. And then you'd probably need the number, the employer identification number, so that you'd have to file for that with the IRS as well. So you can see all this documentation is why it's more expensive really to set up the S Corp and the LLC, which is, again, if the sole proprietor, you just start doing business pretty much. And this is going to be a bit more expensive on the startup cost, which means that if you're talking to someone who specializes in setting these up, then they have an incentive kind of to want to set them up. And then we have the S corporation more expensive tax return as well, because you're going to have to file a whole nother tax return, an 1120S. It is a flow-through entity, but the tax return is still pretty detailed. You're going to have not just the income statement like you would have if it was a Schedule C. It's going to have the income statement and the balance sheet most of the time, usually. And so it's going to be a bit more costly just to file that. It will then flow through to a K1 form. The K1 form will then flow through to the 1040. So you're not going to pay taxes here for the most part. It will flow through to here on your 1040, and that's where the owners of the S corporation would pay the taxes. Although, depending on the state you're in, like California is going to charge some minimal fees for the ability to be an S corporation in California. So depending on what state you're in, you're going to have some different fees. And again, there's going to be some differences between the S corporation taxes and the LLC. So if you're thinking about an S corporation or an LLC, you want to compare the pros and cons of those two. They are both flow-through entities, however, and the basics of it works like this. So limited liability, I'm not going to go through all the setup process again, but it is a longer setup process, obviously, than a sole proprietor. You would then, if you were an LLC that was going to do your taxes at the end of the year, if it was set up as a partnership, then you'd have to file this 1065, and then it would be a similar process in that it would be a flow-through entity that would have to issue the K1 form, and then the K1 form would then flow through to the 10.